Marc Kramer, host of Asian Founders and Funders, and I'm a senior lecturer of entrepreneurship at Vin University. Our show today features Chad Ovel, one of the partners of Mekong Capital, one of the top private equity firms in Vietnam. Chad, welcome.
Thanks, Mark. Appreciate you having me.
Oh, it's a pleasure having you, and I love your stories. I've had Chad at my class. I've heard him speak at the American Chamber of Commerce, and I can never get tired of hearing your stories of success
Thanks.
that you've had at Mekong Capital. So before we dive into the company, why don't you give the audience a little bit of your background professionally, how you got here? I mean, you're an American that ended up in Vietnam, and you've been here since kind of the beginning of the Renaissance economically of Vietnam.
Sure. Well, I grew up in the United States. I did my undergraduate degree in the United States, but I was very lucky to travel and get exposed to Asia while I was in college and fell in love with Asia. So I did everything I could to make it back to Asia after graduating, and I landed a job in Hanoi in 1996, working as an analyst for a private equity fund that was just getting up and going. But 1996 was way too early to be launching a private equity fund for Vietnam. There's hardly any private sector to invest in back then. But I loved Vietnam. I really was so enthralled with Hanoi and the Vietnamese people that I decided to look for some other employment. I ended up working for an NGO called WWF, or the World Wildlife Fund. And I did nature conservation work throughout Laos and Vietnam for about 3-4 years. And then I got back into the private sector to work for a large garden furniture manufacturing company based here in South Vietnam, where I live now. And I spent 6 years with them, initially as the chief sustainability officer, cleaning up all their timber supply chain, getting it all FSC certified, and then moved into leadership ranks and eventually ran their business here in Vietnam. And then I wanted to do something a little different. I wanted to work with private equity owned companies and help turn around and improve performance. So I knocked on the door of Mekong Capital and expressed that interest. And Mekong had just the right job for me, a CEO role in one of their portfolio companies, a Vietnamese company, where I then spent 6 years helping to grow that business and improve its profitability and help Mekong get its exit. And on the back of that, the founder of Mekong, Chris Freund, invited me to join, and I've been here 11 years doing private equity ever since.
Congratulations. So let's go back a little bit to the NGO work you did. How did that affect you in terms of you being even an investor in Vietnam? Like, what was the things that you got out of working for an NGO?
First of all, strategy, planning, thinking ahead, how to execute on a thesis. So planning a rural development project is not dissimilar from planning a business. You really need to think through how are you going to make change, what actions are you going to take to cause that change, how are you going to fund it, finance it, who's going to back you. And so initially my role at WWF was project design and fundraising, which is pretty similar to what I do now. It's just at a different scale. And then the second thing I learned is I actually was a director of a project in the field that was financed by the British government. And so I learned how to be a leader, and I learned how to build team and get results from my team and deliver results for the donor. And then the last piece, which was probably the most uncomfortable piece, was learning how to work with government. And I'm not a patient person, so I learned that it's incredibly important to understand that governments don't make decisions overnight and take a lot of time to change policy and approve things that may be new or different to them. And so that was the piece that led me out of NGO work. I wanted to make a difference to the environment at a quicker scale than I could do in the NGO world. And I saw that working in the private sector, where you have a profit incentive to motivate change, was a better place for me. So I went back into the private sector, where we were able to make substantial change across landscape levels in 18 to 24 months, where that kind of change took years, collaborating with government as a stakeholder.
Well, certainly running an NGO is probably harder than running a private sector company for government issues. And also, you're limited in terms of where you can raise money from because you can't give people an actual return on investment.
Correct. Yeah,
So that was a great place for you to start your career. And then you went to the private sector. And so, and my take on this is because I've run 28 startups, is that you're probably a better investor because you understand what the CEOs go through. And when things aren't going right, they can trust you to do it. So, what are the things that you learn from running a private sector company and having a successful exit that you're able to bring to the job now over the last 11 years?
sure. Um, I learned a lot. I mean, we could talk hours about all my lessons learned
I'm sure
from
you can write a book on
the,
it.
the 14 years in which I was in leadership roles in two different companies here in Vietnam. I'd say one of the most important things was really building team, how to get the right people on the bus, how to make sure those people know where we're taking the bus, where we're going, and to really articulate and design KPIs and communicate those KPIs so people know what they're expected to deliver on and at what scale and at what speed and at what quality level. Um, and it took me a while to realize that. It took me, several years of kind of wandering in the dark, thinking everybody should just know what they should be doing before I realized I had to communicate it. I had to articulate it. I had to design it and communicate it again, again, again. And once I kind of figured that out, things really started working for me in terms of delivering results at the enterprise level. Um, and, that is having been through that journey myself. I can tell a lot of stories about it very authentically to the CEOs of the companies we invest in. I can share my experiences, both good and bad, of what the struggles I went through. And I think, my experience being in the financial industry is it's pretty rare for a financial investor to have actually sat on the other side of the table where the CEO sits in the portfolio company. But I've been there and I've been through it, and it absolutely helps me to relate to what they're dealing with. I'd say one other thing, Mark, that I, key lesson I walked away with is pace of action, the need for leaders to make decisions quickly and be decisive, even in the face of uncertainty. And that's a gift I wish I could give all the CEOs way back by investing in their companies. But it takes time to develop it, to be brave enough to make a decision when you don't have all the facts. And I learned this early in my career in the private sector, that as a leader, if you're not making decisions, you're basically paralyzing the whole organization. And it's okay to make wrong decisions as long as you keep the ship sailing across the ocean. A wrong decision can easily be course corrected with a different decision a week later. But no decision means the ship just stops dead in the water. And I think that's really one of the biggest things we see as we invest across a lot of companies is how do we share that story with founders and leaders such that they're constantly in the game of making decisions and providing that leadership to their team, even if it might be the wrong decision.
Do you think that's cultural? I mean, what's the difference between Eastern and Western leaders of companies?
I'm not sure it's an Eastern Western thing. I think it's different from person to person. And we see this, we're currently invested in 14 different companies across our portfolio. And over the last 23 years, we've been in 45 different companies. And each founder, each CEO has a very different character. I wouldn't say it's, you could easily put it all in one box being Asian or Western. We see leaders who put emphasis on loyalty of their team, where we see others that put emphasis on performance and results. And those are two very different things. And what we often see is in those companies that put emphasis on performance and results, they might have higher turnover. And outsiders may look at that company and say, wow, it's a tough place to work and high turnover. But those leaders are often better at building a team that's going to produce results reliably again. Whereas other founders, they may put a higher priority on loyalty. The upside is they've got less turnover and it's easier to recruit, but sometimes it takes a lot longer to get things done. Because they're putting, priority over keeping people who may not be delivering results over results produced. And if I were to, say, is there some difference between Asian and Western approach? I would see we do see a bit more loyalty factor from some Asian leaders than from the non-Asian leaders that we back. But I wouldn't say it's always that case.
Is there a difference between first-time CEOs and how they're willing to take risk or not take risk compared to serial CEOs?
Yeah, I would say those that we've backed who've been through building a business and selling it before, they, you call them a serial entrepreneur, they definitely are organized around velocity of action. They know the time value of money. And they want to build value quickly because they also want to get an exit in the near horizon and then go do the next thing. Whereas we see those who are first time, there's just such a steep learning curve for them, right? They haven't been through the ups and downs and all the roller coasters that someone who's been there and done it before. But that's fine. We're willing to back those type of first time CEOs, and it's a big part of what we do at Mekong Capital is to coach them through, that transformation journey. What does it look like to run a company when it's 100 people compared to 1,000 people compared to 10,000 people?
What's the profile, and you've told us some of it already, what's the profile look like of a successful CEO that there's not much maintenance involved? And what's the profiles of the ones that are kind of challenging and require more hands-on?
Sure, that's a great question. We ask ourselves that question a lot, and it also impacts the way we choose our investments. I'd say, for us, the attributes of a founder or leader who consistently deliver results and need much less intervention from us as a shareholder or as a coach are those that are very clear about the long-term vision. They can paint a picture of where the company will be in 5 years, and they spend a lot of time communicating that to the team. And they do it over and over, and they can paint a very vivid picture so everybody can see where the company is going. And that first and foremost gets all the people moving in the same direction. Secondly, they kind of cascade that vision down into smaller pieces. So they can restate that vision or that long-term strategic goal in ways that are relevant to different departments, different teams, different functions, or even down to the individual, and speak to an individual and really listen. What does that individual care about in their own life? And how can they fulfill their personal purpose by working at company ABC, right? And helping people connect their personal purpose to what they're doing every day at work. Those are the leaders who really get the whole machine moving and running, and everyone's clear on which way to run. The second attribute I'd say of those leaders are they are very good at listening. So they're constantly looking for ways to improve performance, but they're listening to customers, they're listening to their own team members. They're humble enough to realize that they don't have all the answers. And I'd say a third attribute is they put the company before themselves, right? So it's about the company first. They think at the organizational level. And one example of that is they'd be very willing to recruit someone and pay them more than they pay themselves, just because that person has a talent or a competency or a skill set that they themselves don't have. So they're very organized around building a team to deliver results and debottlenecking themselves. Now, on the other side, the founders or CEOs where it takes a lot of coaching and a lot of support from us for them to have some kind of transformation in their leadership are ones who are shy. They hold back from communicating. They say what their vision is, but they don't make it clear, or each time they say it, it sounds like it's slightly different versions, so they leave the team confused which way the ship is sailing. They they don't want to make anybody feel uncomfortable, so they tolerate underperformance, even though it's really impacting the company's ability to achieve its long-term goals. I mean, all those things I just said might sound ridiculous to you, but it is human nature, to a certain extent, to not upset others, to be right and not look wrong. And a lot of those things get in the way of some of these leaders are really achieving their bigger goals.
Women, I've met a lot of women entrepreneurs in my year being here in Vietnam. Women tell me there is no glass ceiling for them here. They don't think about those things. Why is there such a vibrant women entrepreneurial community here in Vietnam? Even people who've come from Thailand and South Korea say it's kind of an anomaly for Asia that there's so many women entrepreneurs here and successful ones.
That's a great question. Well, first and foremost, I think Vietnamese women are just incredibly diligent, incredibly detail-oriented, and they're fearless. They're just absolutely fearless. It's very rare to meet a Vietnamese woman who gets overly concerned about how she might occur or look to others. They put the goal out front and they make that paramount to all else, and they just go for it. And I think Vietnamese women, coming from a fairly traditional culture where it's typically the female side of the household that does the cooking and the homework, and caring for children, their time is precious. So in the workplace, they are hyper motivated and they get stuff done fast. And they want to achieve all that they're committed to, by the 5:30 or 6 p.m. bell, so they can be home and be great mothers and take care of their family. And they enjoy doing that. And it's incredible how productive they can be. So yeah, I mean, we often have a question from a lot of the people in our ecosystem or constellation who invest in our funds. Why does Mekong Capital, close to 80% of your workforce is female? But it's for the very same reasons that you presented when you asked the question. They're just incredibly industrious, incredibly productive, and just such a pleasure to work with.
Yeah, I have a daughter just like that who has her own global company, and I see the same traits that you see with the women here that I've also seen as well. For the entrepreneurial community that's here, how what changes have you seen, especially since 85% of businesses in Vietnam are family owned? Do you work with the family owned businesses? Do you invest in them? And how does that work? Because there's a lot of personalities and history in those companies.
Sure. It's a question we ask ourselves a lot at Mekong Capital. Over our 23 years of investing here, we have definitely invested in family-run and family-owned businesses. Now, I differentiate the two because they're distinctly different. Historically, in Vietnam, a lot of family companies were family-run. So maybe a husband-wife, maybe a husband and a brother-in-law, or more recently, you're starting to see the children being involved in the business. We have found those to be more challenging situations for Mekong Capital because often those companies start out with a loyalty culture. And the reason they tend to employ so many family members is maybe they start off with a lack of trust for outsiders. So, one typical version of this is my CFO is my husband or my wife because I don't trust anybody else with the money.
Yeah, of course.
That's a typical version. But our retort to that is, it's pretty hard to convince me that your spouse is the most competent CFO in the marketplace. And what we're in the game of doing is growing companies quickly and supporting founders and achieving their visions. And often the most important way to do that is to build a great management team. Now, what's evolved in Vietnam is some families have realized that they really need to be organized around succession planning, and they have successfully built great externally hired management teams. And we're seeing more and more of those companies today. So I would call those companies family owned, but not family run. And those are great investment opportunities because it's the family's values that often are instilled in the work culture and the workplace. And those are typically very good values of ethics and doing business the right way and taking care of employees, and being shrewd with allocation of capital, which are all important attributes for running a good business. But I will say we have not had success, and we continue to struggle in situations where the founder may want to prioritize employment of family members over recruiting the most talented person in the market. And furthermore, the most talented people in the market, they tend to resist working for family-run companies. So it's going to be more challenging to recruit the most qualified candidates to come into a situation where they're going to be reporting to maybe two spouses or two brothers. And so it's a dominant company form in Vietnam. As you said, 85% of the companies are typically family run, but we just haven't figured it out at Mekong, how to make it work. So.
I don't think anybody can figure that out. I mean, once you enter, because family is always going to take priority. I mean, they'll have a son. He's not as good as somebody else, but he's still their son. I've worked with family businesses for 30 years, and they still have to, have Christmas and holidays together. So they don't want to rock the boat too much.
Yeah.
So I understand that. Have you worked with partners, and how do you keep partnerships together? Like, people start a company together, and sometimes in the beginning, when it's rough, they're great together. But as it starts to be really successful, because even family businesses, when the business is really successful, that's when the wheels come off the cart, not when people are struggling. So how have you worked with those kinds of partnerships, and do they usually last, or do they kind of fall apart over time because it's almost like a marriage that gets tired?
Yeah. So that's our favorite type of company, which is a multi-co-founder company. And the reason it's worked so well for us to invest in multi-co-founder companies is even before we come along, they already have a culture of discussion, debate, and consensus building among 2, 3, 4 different co-founders. And so for us to slot in to that conversation as a 4th or 5th member of the founding committee, so to speak, it's a much easier thing to slot into than, say, slotting into a family, right? And yes, in almost every case where we've invested in a multi-co-founder business, one of the co-founders decides to become non-executive, or a co-founder may decide to sell their shares before others. But that's just the natural progression of how these things develop. I'd say about half the times when we invest in a multi-co-founder business, all the co-founders stay in executive roles and continue contributing to the company. But I'd say about the other half of the time, 1, 2, or half of the co-founders evolve in their role, maybe to board director only, non-executive, or executive director. But I think the nature of multi-co-founder businesses is they're very fluid in reallocating responsibilities and what each person does. And so for them to reallocate being executive or non-executive is also natural. So,
what industries does Mekong Capital invest in, and which industries do you stay away from? Because I don't know, they're maybe too challenging, or you just don't have the expertise to go and work in those industries.
Sure. Well, we're quite opportunistic at this time, so we're investing across many, many sectors. But I can tell you the sectors we're most interested in at this time are branded consumer products, software as a service, healthcare, pharma, biotech. In particular, we like to invest in sectors where there is a lot of M&A. There's a lot of financial investor interest. So we can easily rest assured that 5, 7, 8 years down the road, we'll be able to get an exit to, to other investors who think like us, that these are attractive sectors. What we're avoiding are two things. We're avoiding sectors that have a lot of cyclicality, whether that's airline or real estate, because the nature of our business is we raise 10-year funds. And to go into real estate investments, maybe at the peak of a cycle, and then there's a downturn 7 years later, we really need more than a 10-year fund life to be able to weather the storms through a down cycle and come all the way back up to the next boom cycle. And so I think in real estate investing, you need kind of more like permanent capital or 15-year vehicles. The other thing that we're not doing is investing in sectors that require a lot of governmental approvals, whether it's telecom or infrastructure, ports, et cetera. Because Vietnam is a great country in terms of its political stability. It's excellent on its macroeconomic stability. But one thing that is a bit unpredictable and out of an investor's control is the pace of getting approvals. And to build a bridge or to build a port or to build a power plant, it's very unpredictable how much time you need to patiently wait and pursue your licenses and approvals. So I just don't think that's a fit for our 10-year fund cycle either. So.
Understood. What industries should entrepreneurs be focused on developing new companies in particular in Vietnam and Asia as a whole? Because now we're seeing so many Western companies looking to move to Vietnam and see Vietnam as a great launching place. And when you take a look at the coast of Vietnam, so many different ports, it's has amazing, the infrastructure is better and better. And it's a wonderful place to live because you have the sea, you have the mountains, you have everything here, and food is very good. So what do you tell entrepreneurs that if they're saying, I don't have an idea myself, but I would love to start something. What industries should I focus on that you think has the biggest potential?
Well, I think in embarking on any strategic thinking, it always warrants starting from what are the strengths and what are the assets. And in Vietnam, 60 to 70% of the economy is agricultural. At least 60 to 70% of all of the population is involved in agriculture. So there's a huge agricultural resource and strength in Vietnam. Secondly, there's a booming amount of software engineering talent in this country. 10, 15 years ago, there was a huge bottleneck, and it was incredibly challenging to hire coders or software engineers. But the country's done an amazing job of building universities and an educational system that's now generating 60 to 70,000 software engineers graduating from university per year. So that's a massive resource that can be tapped into. And it's a very young group of people that are dynamic and want to grow in their skills and their careers. So also, you've got a country that's very, very connected through multilateral and bilateral trade agreements. So anything that involves trade flows very well here. So yeah, I would just start with, what are Vietnam's strengths and its core assets that could lend your business to being differentiated or well supported. But I'd also ask, what are you passionate about? What are you excited about? What gets you out of bed in the morning? And what do you really want to commit the next 5 years of your life to? Because building a business takes a lot of persistence and it takes a long-term commitment. So if it's not something you personally care about or is connected to your personal purposes, it may be challenging to stick with it in the long run and through those tough times. So that's the second place I'd look.
Many entrepreneurs are afraid to take the leap to go on because they grew up in a culture where you work for a company and that's how you go into your career. What do you tell people that are aspiring to be entrepreneurs? What do you tell them they should, at what point should they take the leap? Should they start working for someone and start a business on the side and then see how the business does and then migrate into the business? What's your advice to them?
I just coming from our own personal experience of investing in a lot of multi-co-founder businesses and seeing which of those founders are most successful. I'd say, going and working for a large corporation for maybe 2, 3, or 4 years, so you can personally experience and witness all the foundational building blocks of running a great company. What does it look like to have an HR team? What do they actually do? What does it look like to have KPIs or performance-based management systems? What does it look like to do business planning? What does it look like to do budgeting? And experience all that firsthand. And the companies we've invested in where co-founders had worked for large corporations, both Vietnamese or multinational, for a few years before setting off and being an entrepreneur, those are the founders who really were able to scale fast because they had seen it and experienced what it looks like to be part of a big company. So I think that's a great path. But the challenge there is it can get comfortable working in a large company, and if you're a performer, you're going to get reliably promoted year after year, and then you start asking yourself, oh, I'll just wait one more year to start my entrepreneur gig, and then it never happens. So I'd also say find some compadres to go with you on that journey, because it can be a very lonely journey going it on your own. But if you can find 1 or 2 co-founders to go with you, and then, like you said, try and test proof of concept in the midnight hours and the weekends, burn a little bit of midnight oil and try and moonlight and build your business on the side until you have minimum viable product and you see it actually is something customers want. And then it's worth going off and committing your life to it.
You've had some billion-dollar valued companies in your portfolio.
Yeah.
And
yes.
One of them is one of my favorites, 4-Piece Pizza, right? Love
I wouldn't say
4-Piece
4
Pizza.
Piece is a $1 billion valuation yet, but yeah, it is a wonderful investee of ours.
But for the successful ones, what's the common thread between them that you've learned? Like, what have you learned from the successful ventures that's allowed you to make even better investments as you've gone forward?
Sure. Well, I'll just try and pick the top 3 or 4 because the list can be quite long. First and foremost, founders who put a lot of time and energy into building their team. Those are the companies that have successfully grown and sustained their growth, is where the founders just always thinking about how to get the right people in the team and how to have the best composition, allocate the right job to the right person. The second thing is dream big, aim big, be bold, declare unreasonable goals. The companies that have achieved billion-dollar valuations are just that, the ones where the founders declare the impossible, declare a future that no one thinks is achievable, but then they just get people excited about that future, and everybody figures out how to make it happen. And the third one is, this might sound cliche, but really figuring out what kind of culture do we need as an organization, and what kind of behaviors do we need from our employees that will deliver the customer experience that we need our customers to feel and receive for us to grow our business. One good example is Mobile World. We invested when they were a very small mobile phone retail chain with less than 10 stores. And during our investment period, they grew to over 2,000 mobile phone stores and 1,000 electronic stores, and built a supermarket chain, listed, and then we sold at our last divestment was at a $1.8 billion valuation. They're now close to $4 billion market cap.
Wow.
They were incredibly deliberate about saying, what kind of behaviors do we need from our employees out there selling mobile phones to Vietnamese consumers? Do we need to be caring? Do we need to be listeners? Do we need to be what do we need our team to be organized around, and what kind of behavior set to give the customers the experience we think will grow the business. And they put tons of energy into that. And they were able to build a very consistent corporate culture across all those stores. So it didn't matter, Mark, if you go shop in the store near your apartment or in the store near Vin University, you're going to get a consistent experience. And Pizza 4Ps, you mentioned it earlier, as another example. They're very deliberate about this extreme Japanese service culture. And they put so much effort and energy into elaborating that culture and training their team in that culture. And it doesn't matter which 4Ps you go to, you're going to be overwhelmed and wowed with the kind of service culture there. And that's what delivers great results and growth for these companies. So,
when entrepreneurs ask you, what kind of books, podcast, anything, what do you think I should be reading and who should I be reading? What do you tell them?
wow. Well, first of all, I'd ask, well, what challenges are you facing? Because I don't want to recommend something that doesn't speak to their concerns. So usually it starts with, well, what are you committed to achieve this year? And are you on track to achieve that? Where are you off track? And what challenges are you facing to achieve it? And if the challenge is, gosh, I find it so hard to recruit, well, I'd recommend a book called Who. Or they might say, I find it so hard to keep my employees motivated. And say, okay, well, I recommend a book called Why Motivating Your Employees Doesn't Work. Or they might say, I really struggle with, getting my team to understand where we're going in the future. And I'd say, okay, well, read Start With Why by Simon Sinek. There's basically so much great material out there that can help a founder think through, the challenges he's facing. So I think it's very specific, very specific.
And for a lot of entrepreneurs ask me, how do you figure out the valuation for when you're raising capital? I think that's what stumps every entrepreneur.
Yeah, well, unfortunately, I think the answer is the valuation is what the market's willing to pay you. But that's not how a lot of founders are taught to think. I think a lot of founders are taught to think in terms of what did the guy down the street get for his company? So I should get the same for mine. And unfortunately, that drives a lot of valuation expectation, right? So founders meeting each other over coffee shops or lunches and comparing notes about, oh, I got 10 times revenue and you got 2. What happened? What's wrong with your business? It really, valuations are incredibly different from sector to sector. And I would say just start by looking at companies in your sector that are listed where valuations are readily available. What are investors willing to pay for a company in your same sector of size, of scale? And then you're going to have to discount that because, you're at a smaller scale, you're not listed, you're not liquid. And then go do some price discovery in the market. Invite a few different investors to look at your business and ask them to make offers and see what the market tells you you're worth. But what I wouldn't do is listen to what my friend in a different business got for his company and then expect the same for mine. That's a trap I think a lot of people get into. So.
Yeah, I agree. When companies are presenting to you, especially entrepreneurs, when they're presenting, how many slides should they be showing and how much information should they provide? I mean, what's that look like when they're presenting to you?
Yeah, so the first meeting, we actually don't really want to see any slides. We just want to hear the founder articulate exactly what his business will look like 5 years from today. Just walk me through, paint a clear picture for me. What will your company look like? Which customers will it be serving? What metrics will you look at as measures of success? And then, tell me what challenges you expect you're going to face along the way in getting there. And that can fill a whole hour, just those 2 questions. And the reason we typically don't want to churn through a lot of PowerPoint slides is we're not really getting under the hood and seeing, how does the founder think about the business and what, are they really dealing with the challenges in front of them? Now, a second meeting, we're definitely going to want to see a few things on slides. We're going to see, what are the measures you look at to see if your business is healthy? What are your unit economics? Does your business actually produce value for customers, and how? We want to see, typical numbers like your margin or your EBITDA per unit. And is the unit of your business actually functioning and working such that our capital can help you just scale that up? We also want to understand, how many different products or services do you have, and what is the mix of those across, by revenue or by profitability? And we're not so much trying to do financial analysis. We're just trying to see to what extent the management team actually has their hands on the profit drivers and where the business is actually creating cash. So that's why we ask those questions.
How long does it take from the time you meet the entrepreneur to the time you actually make the investment? And what's that process look like?
It's typically 5 to 6 months. And the process typically starts off with 1 or 2 meetings where we get to know each other, and the founder, paints a clear picture of his long-term vision. And then we say, we'll go back and discuss internally, is this something we want to spend our time on? We say yes. And then we'll go and have maybe 2 weeks of conversations with the company about their detailed business plan, their financial performance, their budget for the current year, what they want to use capital for. And then we're going to do what we call an initial appraisal and discuss internally whether this is something we want to spend even more time on. And then we'll come back and make an offer. We call it a term sheet, which usually outlines valuation, amount of money we want to invest, and some other aspects. We may have requests that they make some changes to the structure of their company or who's involved. And then if both sides can agree on the term sheet, then we're going into what we call full appraisal and due diligence, which can take anywhere from 6 to 8 weeks. And that's where we hire third-party consultants to help us diligence the business, whether that's a legal due diligence by a lawyer or a commercial due diligence where we hire a former founder, CEO in exactly the same sector to come and kick the tires, or a financial due diligence where we really verify the numbers that are reporting to us are accurate. And then we would negotiate legal documentation for the deal, kind of like a buy-sell share agreement and a shareholders agreement that would kind of govern how we work together and the principles of our partnership for the future. And then we sign the deal, and we call down capital from our investors and make the investment. So it's a pretty intensive, it's a lot of work to get done in 5-6 months, but that's typically the time period it takes to close the deal.
Well, what makes you walk away? Like, you invited people in who you think, man, they look really interesting. And then either after the first meeting, or it could be after the presentation, what usually scares you off where you say, I don't think this is going to be good for us?
Typically, the number one factor is the more time we spend on a deal, the more surprises we have. Like, things that we would have expected to have been disclosed up front don't get disclosed until later. Like, we ask in the first couple meetings, so do you have any family members working in the company? And, oh, no family members. But then, maybe 6 weeks in, we're in a meeting and we realize that the person sitting across the table for us happens to be the wife of the sister-in-law of the CEO. And like, whoa, what's going on here, right? It's those kind of unexpected surprises that really demotivate, and then we start having second thoughts about a deal. But it can take many shapes or forms. Like, yes, we have 10 stores, and then we go and visit every store, and we get to the 8th store and it just happens to be closed. Oh, well, I thought you had 10 stores. Well, yeah, but store number 8 is temporarily closed because of some issue with the landlord or something. Why not disclose it up front? It's just strange, right? So that tends to be the number one factor, is unexpected surprises. Another one is sometimes the more we know about a particular sector, the more we see it's incredibly challenging and hard to scale. And so that comes through us doing a lot of expert calls, meeting people in the same industry, in the same country, or countries around Vietnam that have similar structure as Vietnam. And, listening to their stories of trying to scale a business, same sector. And if we see that it's just really hard to scale, then we're going to dial down, kind of the financial model and the expectations on growth. And then sometimes you just see you can't get the investment return we expect, so we'll walk away.
What should the entrepreneur, when they're meeting investors, and really good companies have multiple investors interested in them, what's the criteria they should use when picking an investment partner?
Great question. I think they should ask themselves, to achieve my long-term goals, or you can call it vision or growth strategy, what challenges do I face and where do I need help? And where do I have, a big I don't know what I don't know, and I wish I had somebody by my side that had that experience. So first, really being authentic with themselves about what they don't know or where their struggles are, and then finding a partner who brings the experience set to the table, and does actually plan to row the same boat with the founders, as opposed to just fly in and fly out for board meetings 4 times a year. Now, a lot of investors will claim that they're going to bring a lot of value add and they have a whole team behind them. So it's important to do reference checks, call CEOs or founders of companies where that investor has invested before, and ask them did that investor live up to their commitments, and what kind of partner were they after they invested, after the marriage, right? So I think that's an incredibly important thing to do, is do reference calls as well.
Last question. Every entrepreneur under the age of 30 is really concerned about work-life balance. At what stage can they actually expect realistically to have any kind of work-life balance if they become an entrepreneur, especially if they're going to want to raise capital, and now you've got a partner who wants to see this thing grow as fast and as big as it possibly can be?
I don't think it's a matter of some magic time in the future. I think it's purely a function of how well they build their management team. And they'll have a wonderful work-life balance if they can build a team that can execute and deliver results as per their vision. And actually, they should be doing that in any circumstance, whether they want work-life balance or not, because the better they are at building the team and the sooner they get it done, the more they free themselves up to really do what the whole team needs, which is the creative thinking, the innovative thinking, looking and seeing what's possible out in the market and bringing those ideas back to the execution team. So I'd say, it's possible to have a very good work-life balance from day one, as long as you're organized around debottlenecking yourself and doing so by building the team around you. So.
I want to thank you for taking the time to speak to me. I would love to read the book when you finally write the book on your experiences. I think that would be awesome. So thank you again for taking the time.
Sure, Mark. It's a pleasure to join you. Great questions.